Welcome into a daily editorial here on the KE Report. In this daily editorial, I am chatting with Jordan Roy-Byrne, founder and editor of the Daily Gold. And Jordan, I just want to get a general comment from you regarding the action that we have seen in the precious metals this week. It's been slow, but it has been slow with a little bias to the downside. How significant is it in your eyes that, at least for right now, halfway through the week, we are not seeing a rebound of any sorts for the precious metals after that pretty devastating, or at least significant in a sense, sell-off last Friday?
Well, Corey, yeah, I mean, the action has been not good, to put it mildly. I mean, I think to step back a bit, I mean, I know we might talk about sentiment a little bit, but we have had, at least from the daily sentiment index, we have had some extreme bearish readings, and that hasn't produced a rally yet. But then if you actually look at the chart of gold, it's really not that oversold. I mean, it did have that big drop the day after the Fed, but I wouldn't look at it and say it's technically oversold until it got down to probably, 1260, 1250. I mean, it certainly declined about, $90 or so over the last few months. But if you look at the chart, it has had some rallies. I mean, leading into the Fed, I mean, gold had rallied. It was a weak rally, but it did rally from a low of 1281 up to 1311 or so. So it did have a $30 rally over the course of several weeks. So we did have that big decline the day after the Fed, but the market was not close to being oversold at that point. So the weakness here just tells me that gold, it may rally for a day or two here and there, but I think it's leading to probably a test of 1260, maybe a little bit lower at some point, and that could lead to a decent snapback. But here and now we're just kind of we're not that oversold yet. There's really no buyers, and it's the same thing when you look at the stocks. I mean, the mining indices, GDXJ, or the ETFs, I should say, they've kind of drifted slightly lower. They haven't completely broken down yet, but there's just really, I know there's not that many sellers out there, but there's even fewer buyers, in my opinion. So I think we're going to need to see, in short, I think we're going to need to see some more selling and lower prices for a sustainable rebound, for something that could last, at least a couple weeks or a month. We're going to need to see some more selling and lower prices before we get to that point.
In all fairness, Jordan, it was something you and I were talking about a couple months ago, saying that a general kind of washout, some lower prices could actually be the thing that entices some more buyers into the sector. And you're absolutely right. Yes, we're not seeing a ton of sellers, but there are even less buyers right now, maybe being distracted by a number of other markets, but also maybe understanding that the scenario for a rising gold price just isn't lining up right now. So this general sell-off that we are selling, you're right, we're not in oversold territory, especially on the weekly charts. But let's talk about the CoT reports, especially for gold. After a general sell-off that we were seeing really from the beginning to middle of April, in your eyes, we weren't seeing any sort of correlation in terms of more bullish CoT reports as the price was moving down. Can you take us through your thoughts here?
Yeah, and I think this is an important point to look at, because if you follow my work, you know that I measure the CoT in percentage terms. I look at the net speculative position and I divide it by open interest, and so that gives me a percentage. And basically the last several major peaks, 2011, 2012, 2015, have been around 55, 56%. And interestingly, I mean, the CoT was looking very favorable early this year. It was only above 40% for more than a week. So it really looked encouraging several months ago that, I mean, if a lot of speculators wanted to push the market higher and break it higher, they could have done so. But unfortunately, Corey, I mean, what we've seen, especially in the last month or so, is I want to say about 3 or 4 weeks ago, the net spec position got down to about 22, 23%. And that was when gold made its low at about 1281. Unfortunately, we had a reading of 31%, and that was as of last the close of last Tuesday with gold around 1,300. So that's really negative, because what happened is gold basically over 3 or 4 weeks, it traded lower, but the net speculative position went higher. So what that tells you is that over the last month or so, the commercials were really aggressive. They were aggressive sellers into that week rally from 1281 to 1311. The commercials were really aggressive sellers. I mean, if they were less aggressive, maybe the net spec position would have gotten down to 20% or 18%, and we would have gotten more of a rally. But that hasn't been the case. So I mean, that's another concern. I mean, that tells me that they're probably, I mean, they're really aggressively selling the gold price around the 1,300 level. So that probably tells me that they think it's going to drop lower, at least to the mid 1,200s. So, I mean, that's a negative in that they weren't more, I guess, supportive of the gold price as it broke below 1,300. I use the daily sentiment index, and I know others use that, and we see a lot of people posting that on Twitter, but it's really not as significant as the CoT, in my opinion. That's really the most important sentiment indicator. So unfortunately, I mean, given how gold is kind of cracked here, it would appear that there would have been the chance for the net spec position to come down even lower, maybe be around 20% or so, but that just hasn't happened because the commercials, as we got this rally, they just got really a lot more defensive, and they were selling their bullish positions aggressively. So that tells me that they're preparing for another move lower in the gold price. So the bottom line is, as far as the CoT, sentiment is not at an extreme bearish position yet.
Well, and considering the CoT, I agree with you that it is more important than the DSI because of the fact that the CoT, I think, encompasses so much more money that could be either long or short, whatever market you're looking at. How important is it going to be looking at the next CoT report that we get this coming Friday, because the measurement date is Tuesday? So last week that report measured it on Tuesday. This week we'll get a better feeling of what the market thinks of that drop after Friday.
Yeah, I mean, I would, given that we're at 1278 now, or 1278 after yesterday, I should say. So we had about a $22, $23 change over the last week. I'm sure that 31% figure will be lower, probably in the mid to upper 20s. But nevertheless, the bigger concern is just the trend of the market has kind of shifted from bullish to bearish. And when you're in a bull market, it's just the parameters for analyzing sentiment have to change. So we can look at this and say, oh, well, sentiment a couple weeks ago when it got down to 22, 23%, that was the second lowest position in 2 years. And all that happened was gold rallied from 1281 to 1311, and it went below that quickly. I mean, it lost that rally very quickly. So that's not, that tells you that we really need a lot more bearish sentiment to trigger a decent snapback. And I mean, that's just what happens when a market changes from bull to bear. I mean, it's kind of semantics because we've kind of been in a sideways market for a while, but look, when you're in a bull, if we were in a bull market and gold had made higher highs and it was trading at 1450, then I'd say this positioning is great. We're only at 31%. I mean, there's plenty of room for speculators to come in and push this higher, but gold has kind of cracked recently. It's failed to break out. And looking at 2014, 2015, and then the low we had last summer, which was around 15%, you really need to see the net spec position come down well below 20% to have a decent rally when the market is, not breaking out or not really in bullish mode. So unfortunately, Corey, that means we could see, we might have to see quite a bit more selling. We might have to see $50 or $70 drop for that to happen.
Okay, let's look at another market here that is very much connected to gold. Let's look at the silver market, and more importantly, some of the silver miner ETFs. I have the SIL chart in front of me. We can also look at the SILJ chart. these charts, I have to say, you pointed out to me off mic, you said pull these charts up, and you look at this SIL chart. This is not a very positive looking chart in my eyes. We are so close to breaking down below a range that we've been trading in for well over a year and a half now, testing out some levels that we haven't seen since early 2016. This is a bit worrisome, especially when you take a step back and understand that a couple weeks ago, a lot of the precious metals bulls were saying, look at silver, it's outperforming gold. Even though gold isn't doing much, silver was moving up. We weren't seeing any correlation there with the silver stocks. What do you think about, first of all, this SIL and SILJ chart?
Well, the Corey, you're exactly right. The SIL chart, it's failed at the 200-day moving average several times going back over the last 18 months. And really the biggest, I shouldn't say biggest, I should say really the wake-up call, I think, was recently in the last couple months when the SIL peaked a couple times right at once at the 200-day in April, and then in May a couple times where the peaks were not even close to hitting the 200-day. So in other words, you go back to 2017, the market peaked. Its peaks were slightly above the 200-day. Then the January 2018, it looked like it was a tiny bit above the 200-day. Then you go to April, it peaks right below it, and then the peaks are even below that. So in the last couple months, the loss of upside momentum or the loss of strength in silver, it really accelerated in the last couple months. And that's why we've seen in the last 5 or 6 trading days where it's really starting to fall apart. And now the low that SIL made, I think in February, that was even lower than the December 2016 low. So the low in February 18, that's an 18-month low, not quite a 2-year low, but very close to it. And SIL here and now is really close to testing that low. And I mean, if it goes below that, it's really in full-blown breakdown mode at that point. I mean, it's trading at 29 right now. The next strong support is around 22. So that's a potential downside target. But Corey, the bigger issue is, silver has been kind of trading in a wide range. It's been trading in a big triangle. The range of that triangle is now compressing where it doesn't really have much room on either side. And look, with the way SIL is acting here, where a breakdown looks almost imminent, SIL is really oversold, so it might rally for a week or two before it breaks lower. But the action in SIL is telling you silver is probably going to follow at some point and break to the downside of its triangle. With respect to SILJ, that's been holding up a lot better, but it's still a bearish chart. It's still something that I'm just pulling it up here. I mean, it's been stronger. It's at least been hugging the 200-day moving average in the last couple months, unlike SIL. But nevertheless, I mean, it's just that both charts are bearish, and it's just a situation where SIL is really a lot more bearish than SILJ, and I assume that SILJ is probably going to follow SIL to the downside. And look, silver the silver gold ratio, Corey. I mean, we were talking about this off air. Silver outperforming gold, I mean, that can happen, and it can kind of be in a bad precious metals market. I mean, it did happen, I think, in the early 90s. People are going to look at that, and they're immediately going to point to 2001, 2008. Those were the beginning of massive moves higher in the sector. Just because silver is outperforming gold, that doesn't mean that that's going to happen where everything precious metals is going to be soaring. Yes, that will happen at some point in the future, but here and now, the outperformance in that ratio, that doesn't really mean anything to me as far as market outlook. You have to look at the charts, and the trend in the silver space is clearly down, and perhaps dangerously so as we get into the months ahead. I mean, I don't want to sound too bearish, because if silver does break down, at some point in the next 6 or 9 months or so, it's probably going to make a historic bottom. But you have to understand where we are here and now, and what might happen to lead to that major bottom. It could be a lot of pain in the near term. So I don't see anything good here for silver. I don't see any reason to be betting on it as far as a bullish bet. It's just SIL is on the cusp of a breakdown, and SILJ and silver as well. They're probably going to follow. And you just have to be, if you're a bull, you just have to really stand aside and let this market break down at bottom, or let it gain a lot of strength and prove me wrong.
All right, Jordan, we're going to leave it there. I always appreciate your unbiased comments. You look at the markets very much the way I do, understanding that it's a big world out there and many factors are at play. Looking at these SIL and SILJ charts, I encourage everybody to pull those up, especially the weekly chart, and just see the general weakness that we've been seeing and how that very well could easily correlate to the next move for the actual silver price. Jordan, great chatting with you. Have a great rest of your week, buddy.